welcome again to episode 2 of Next Move with Travis and Eric. And this episode 2 is going to be focusing on banking and digital currencies and what are the differences between e-tokens and tokenized deposits, tokenized real world assets. And so I'm your host, Travis McGregor, and I have my co-host, Eric Maloney. And say hello, Eric.
Hi there, Travis. Hi, Adrian.
Eric's in New York, and in Florida here we have Adrian Martinez with an extensive background in banking as our guest today. And hello, Adrian.
Hello, Travis. Hello, Eric. Happy to join you.
Yeah, on the first episode we had Robert Wakeling on talking about how mobile communications can be a hybrid in an environment where we take cloud-based blockchain, consensus node for immutable data, and we can achieve immutable data in SIM, tamper-resistant silicon. So what do we do with that? And so over the last maybe 8-10 years, we've all seen this, cryptocurrencies and Bitcoin and stable coins and tokenized real world assets and so on, and tokenized deposits. And, there's a lot of buzzwords with tokenization, and, this is not new. I mean, Apple tokenized credit card transactions many years ago, but too early for blockchain adoption and so on. So many companies have said tokenization as a word, and today's episode is really to try to clarify and put some definition with that. And so what I'm going to do is, before we get into questions and discussions, I'm going to classify 2 categories of money, and it's all digital money today, not hard currency and paper notes. All classify e-tokens as Bitcoin, cryptocurrencies, altcoins that fluctuate in the wind. And these ones, even stable coins pegged to the US dollar, are outside of banking ledgers and so on. And the other side, so that's all e-tokens. And they have to on-ramp and off-ramp and so on to get into, let's call it, and Adrian, you've used this before, is the real world of commerce. And then on the other side of the house, we have this, tokenized deposits, and JP Morgan with Onyx is out there and saying, hey, we've done this, we can move money around instantaneously and so on. And maybe as a clarifying point on the narrative I'll hand it first to Adrian. From your perspective at HSBC and Citi and so on, what is what is the framework in your mind? How would you best describe on this show what tokenized deposits are versus the world of this open money of e-tokens?
Yeah, absolutely, Trevor. So I think importantly, the distinction you laid out was that, the tokenized things that most people are familiar with when they talk about blockchain is cryptocurrencies, right? Which are standalone, tokens of value that are maintained within a blockchain environment. But tokenized deposits, I think the name implies that it's something radically different, but it's not, right? A tokenized deposit is essentially the exact same deposit that you hold in your checking account today, except that it has been placed or encapsulated in a token, which can then exist on the blockchain and can be moved by the blockchain versus being moved by what we're familiar with, whether it's ACH, wire transfers, paper checks, handing of cash. In this case, it's something. And in particularly, as you spoke about, Onyx and JP Morgan and other, kind of proofs of concept or tests that have been done, it's highly correlated or related to smart contracts.
Right.
So the facility that exists on the blockchain or distributed ledger to create smart contracts so that tokenized deposits don't require an action, in which case it could be
that's the heart of it. Yes.
Manual by not manual using hands, but manual by saying I have to log in, push a button, make a call, tell somebody to send something. The smart contract enabled with the tokenized deposit can merely execute the transaction when certain conditions are met.
Absolutely. And what comes to mind is this new word called programmable money, meaning that the parameters of the smart contract are going to pay party A to B and the rest of it, and it's all systematic versus some of the intermediary steps of maybe a Bitcoin, because Bitcoin doesn't sit on a ledger. It sits separate to that and has to be liquidated to put it into fiat, for example.
Correct. Absolutely right. I mean, it's no different than the types of transactions that we do on a recurring basis personally. Payment of your utility bills, right? You could imagine that if you were to enter into a distributed ledger blockchain contract with your utility company, in which you had tokenized deposits that were part of that, and those tokenized deposits would automatically be transferred to your utility company once they billed you for the month's consumption.
Beautiful. Yeah, that's a very good way to say it. And I'll turn it over to my co-host Eric. And when you look at this, and I know your background is phenomenal in human and machine automation and AI now, and going back and architecting financial services and banking systems and so on. And from your perspective, is that it's been a lot in the news and so on about compliance. And so would you say that, Eric, is that a bank operating tokenized deposits versus a stable coin, are they viewed, you think, from a compliance in different ranks? Because one's internal to a bank, one's external. What comments do you have to that?
So I like the summary that Adrian gave, and you brought up the smart contracts. The banks cut their teeth with the internal processes, right? They tokenized processes for end of day processing, right? Clearing, foreign exchange, everything else. So they've already tokenized those processes. They know that they're going to work. They have not only the immutable data, but an immutable log of everything that took place in those smart contracts. So from a security perspective, the forensics are much easier. The systems are known. More of the human error is taken out of these processes. Now we're reaching a point where the larger banks are able to say, well, we know they work, having these blockchain ledgers working on their internal processes. Let's start extending them to some of the digitalized assets of our partners, our customers. So they're just going to extend what they've learned over the last several years, and now allow people to have tokenized deposits for, as Adrian said, for regular payments, also hitting certain rules for retirement planning. You're going to see a lot more of this in wealth management, where before it's kind of the trust of, oh, this person's going to be doing this wealth management portfolio work for me. I really hope that they're fiduciary at heart because they're not by law. But smart contracts can start mitigating that. As Adrian was saying, you can now have some very clear criteria that you agree with on how you can have maybe ethical investment, and the right funds are going to meet the criteria to be in the portfolio that is managed for the customer. There are going to be disclosures that the mix will be maintained. There'll be disclosures of risk reports that are trusted, that go back to the types of funds that you're having the investments against. I'm just using the example of wealth management. You can extrapolate to other areas of financial services. It's going to be much more transparent, and anything transparent is going to be a lot easier to apply compliance and regulatory overview to.
Well, that really hits, a lot of these proof of concepts or tests or pilots, Barclays and BlackRock and JP Morgan Onyx and so on, is this auto rebalancing of wealth portfolio investments. And so, like you said, if I have a certain percentage in a very low risk yield position, that's going to be my bread and butter for the future. And I want to have that consistent, the transparency and knowing that would auto shift based on certain market conditions. I, as an investor, for my family succession, would want that, and to have that visible, like you're saying. And I can see that the compliance will be not just with the bank or the MTL or whoever it might be, but your fiduciary. That's what I like too, is right. You actually can keep these fund managers, keep them on point,
Yeah, it keeps them on point because the transparency, you'll be able to read your smart contract in a sense, right? You'll know what the terms are. I see this making it harder on wealth managers, in a sense, harder on lawyers to litigate these things, because it's going to be more cut and dry on what was expected, what was executed, and all the evidence of the transactions.
Well, and Adrian, I want to ask you this: is so I bank with JP Morgan Chase personally, let's say, and I have various accounts. I look at the mobile app online. I go into the branches. When you were saying that not a lot changes with tokenized deposits, do you envision that anything at all with that UI, mobile apps, web, and the rest of it would change, or like you said, it's just a more secure database?
Yeah,
How does that affect the real world applications out there?
yeah. So I think from a real world application perspective, I mean, you can almost envision it now. So if you were to log on to your mobile banking, solution with JP Morgan Chase or any other bank, right? You would have various options: move money, pay bills, whatever, right? And within those, then you would have a drop down, right? It would say, how do you want to send this, right? Is it an internal transfer, external transfer, is it foreign? Is it a wire? How is it going to be sent? Are you pulling? Are you pushing? Whatever. In this case, with this or bill payments or something, you would be able to establish it and we would probably have another menu option, right? And what that menu option would be called, would it be called smart contract? Would it be called, tokenized deposit? Probably tokenized deposit, right? And you would say, and then you would go in and you would set those parameters, right? You don't need to be, a distributed ledger, R3 Corda or, consensus or whatever programmer, right? In theory, the system would do it for you and create that contract, send it to the other party would have it, and then things would be executed. But another component, touching on it from a compliance perspective, which you were talking about earlier, just before, is it automates compliance by your service provider, i.e. your bank.
Yeah.
But for the bank, it automates compliance as well, right? So in the example that we talked about where we say, okay, you've given your risk appetite, to your investment advisor, right? And then they're executing, they have some, autonomy to trade on your account, right? It's given to them and they're making trades and you're like, well, are they doing it in accordance with whatever? And you have your smart contract,
Right.
which ensures that happens, right?
Yeah.
For them, they have monitoring requirements, right? And they have to go look at whether an advisor or a broker dealer, or a broker executed transactions in accordance with and trades in accordance with your risk appetite. In this case, they don't have to go search for trade. They don't have to do anything. They can go look at the record in the blockchain, right? And see that the trade was executed in accordance with the contract.
Yeah. Yeah.
Right. And the same thing for any monetary transactions, right? Somebody can go look at it and say, did this transfer happen on the required date, in the required amount, to the, recipient, and was everything done? And has it been done in accordance with the contract for the period of the contract, right? So it simplifies compliance monitoring for the financial institution as well.
Well, this brings up a million different things, and so when I started in this 2017 in the blockchain, is everyone had this ultimate dream that everything would be on chain, everything is crystal clear. It's never going to happen right away. I see this as, you look at a big bank, it's got all these ledgers and different programs. You kind of have to isolate one and say, hey, we're going to do it a new way and have it kind of organically grow out. Because otherwise, it's too much of a change. So we're talking to banks,
and we have to be clear, right? It's not applicable to everything, right?
That's true.
So for instance, if we looked at debit card or credit card transactions, right? There's no need nor utility nor will it improve anything in the current environment because those transactions are happening in fractions of a second.
Yeah.
Right. A distributed ledger cannot react that quickly, right? So it's not going to. So certain transactions won't migrate, nor is there an explicit contract other than you walking in, ordering something, and then paying for it, right? It's an implied contract, but it's not something that you would write down or require a tokenized deposit to do. But to your point on ledgers, it's when we talk about tokenized deposits, we have to understand that there are essentially, at least today, 3 different options, right? It can be a private ledger, which is a ledger within an institution or firm, right? In which money is being moved potentially between mutual customers of an institution, right? So I can pay Travis because I'm at JP Morgan Chase and he's at JP Morgan Chase, and we can set up a contract and then we pay. And then there could be, a more limited, right? So a consortium view in which there's 10 banks, 10 financial institutions, or 10 firms, some banks, some not, in which money is going to move, right? And only those participants in there. And then there's a universal ledger, right? Which is probably the furthest down the path, but it's one in which probably tokenized deposits becomes probably more widely accepted and probably one of the primary means of moving money, right? Because then you become ubiquitous, right? Then you just say, It doesn't matter who's over there. I want to use tokenized deposits to do it, and we know that it's going to get there. Now, that doesn't necessarily mean that everybody has to participate, right? Because it's just like FX today, right? There are people who can conduct FX and there's people who are not. So there may be correspondent banks, large banks at a regional level that are going to provide this tokenized deposits capability to smaller banks who, who aren't necessarily signing up, but it then provides ubiquity and then provides the ability for tokenized deposits to be used across a whole, range of, internationally, globally, and then across the whole host of use cases.
Yeah, and it's interesting. It's a very good point, because you're not going to have tokenized deposits for everything that we enjoy and use money for today. And I'll give this to Eric, is that, I'm going to say something a little bit, grandiose, but the U.S. acts as like the Federal Reserve Bank is somewhat of the central bank of the world right now. We design this fiat system and so on. And do we, Eric, follow in tokenized deposits that model? So the big money with the central banks of the world and the rest of it gets distributed down. Is that where we're going to go with tokenized deposits and then the branch? How do you see this from your architecture perspective and background now that you're really involved in AI in the cloud? How would we go about this? Because some think that they can just throw up a cloud blockchain and they're the bank of the world. What do you think?
So they're deconstructing you raised a few different things. First off, let's go back to the types of tokens.
Right.
I'll kind of circle back on how AI might fit into some of these aspects. The tokens can be like currency, which is you have to have trust in whatever you're using as a medium of exchange, whatever these tokens are, right? Who's providing that trust?
Right.
Federal Reserve, you're trusting the United States federal government, right? And that's where they get their authority, and it's that hard currency that the world sees, and everyone wants a greenback because they know there's a government to do something about maintaining the integrity of that money.
That's right.
Right? And if they do create a U.S. digital coin, right, which would be a stable coin associated with the U.S. dollar, or in some way they regulate stable coins associated with the U.S. dollar, which they have not done yet.
Yeah, that's a good point.
They have not done that yet.
That is a very good point.
Then, people would extend, just like Adrian said, I understand my deposits are equivalents. And the Federal Reserve, the U.S. government recognizes them, and I can use them like we use dollars, but just now I'm using them in new digital MILUs. We're not there yet. So we get back to trust, and that's why you see all this world talk about Bitcoins and ETH, and the token coin of the day. I think there are probably 75,000 different coins out there. And don't worry, the number will collapse. It's actually starting to collapse. There are new ones starting up every day, many more failing every day, and they are having different models. Some have algorithmic logic to make their value somewhat stable, to be a stable coin, so to kind of limit the availability when there's too much, make them more available when there's a need. There are others that associate them with equity holdings. They'll say, oh, we're going to reserve actual fiat currencies somewhere associated with these digital coins. We're not a government of the world. We're acting like an independent reserve. And there are others that associate them with underlying assets like commodities. They say, we're going to associate these tokens with gold, bullion, or something else, and reserves. Very interesting things like reserves in the ground, like unmined gold and silver and other things. So there's so many ways, and there's going to be a lot of regulation on this that is not there yet. Okay, I like the term "is not there yet." So you have to be kind of cautious about where you go. My only last thought on coins is don't invest in a particular token. Don't bet on buying enough Bitcoin. Don't bet on buying enough of a particular type of coin, because you're missing the point of the value of the transaction.
No, that's true. That's true.
Focus on how you're going to use the coins, how are you going to put them into a deposit. Two, as Adrian said, select more options from your financial provider, service provider, or new services that are created. Finishing on the other part of the digital world, AI will allow the scale to continue. Blockchain allows, a distributed ledger allows for scale. Adrian's right about some of the performance limitations, and that's not all bad. It just is a fact that it's not going to have the millisecond return time that you might want for a credit card experience. But when you start scaling out blockchain, we start optimizing the performance of blockchain, and you want to have that oversight, that auditing, it's going to be done by AI, not by human eyes. And at scale, you're going to have a lot more AI doing that monitoring, doing that reporting, looking for the outliers to see where some of the smart contracts may have flaws or some aspects that were unintended, right? AI is going to be very good at that. And finally, AI will be good at helping us not have to templatize the smart contracts of the future so much, because you'll end up with a massive library of redundant templates. You can now have AI start looking at the terms of the smart contracts and saying it's 95.55% the same as that smart contract. You know, do you really want to make the difference? And here's the delta. So it's going to be much easier to generate the contracts and understand what you're signing up for with AI as your advisor of some level of what these smart contracts will do. There's no limit to how you can train AI to work in this new world, but it's going to be necessary for scale, compliance, and control.
Absolutely. I mean, what triggers in my mind about trust, and we're running out of time here, so we can try to keep it to 15 minutes, is, and also that stablecoins aren't regulated to the point that it's etched in stone, because, you know, the spokesman for the Federal Reserve banks, hey, we're not giving the assurances as we do the central banks on the US dollar that we do stablecoins. And we've seen, you know, pegs go to 25, 6, 30% off peg few months ago and the rest of it. So those two scenarios, solving the peg, a run on liquidation on, like, you know, Circle's USDC or whatever, you know, Tether, whatever stable coin out there, and also the US saying, hey, we're going to support more of the US dollar right now until we figure all this out. It's a very interesting time. And then when you bring AI to analyze the delta in these smart contracts, it's a brave new world. And even though, you know, you see in the press and the rest of it, all these, and I think, Adrian, you said that when we first met, is that, you know, hey, I was talking about all these use cases back.
Yes. Years ago.
And now it's just a reality after all these years.
We're
to actually do something with this stuff.
And the conversation at the time was it's going to happen like tomorrow. And here we are, you know, probably 7 years from that day when you know, when the guys from Consensus were talking about this, right? Where we're going to have smart contracts and they're going to execute, they're going to send money and they're going to do all that. And, you know, here we are. It's 7 years and we're getting to a point which I think is, you know, one article called it 2024 is the year, right? It's finally getting to the point where, you know, it's going to be done. But just one thing, you know, the difference is you raised at the very beginning, talking about these various tokenized assets and what they are, is that the tokenized deposits are the same as money. And working within the banks, they are regulated. Right? So nothing changes about the character of the deposit by tokenizing it. It's still regulated, it's still carried, it's still going to reflect. I mean, your balance in your checking account or savings account will reflect $1,000.
Right.
500 of it has been carved off and is sitting on another ledger.
Right.
Right. To be used when the smart contract calls for it.
Right.
Absolutely. But all of those, you know, all the regulatory things, FDIC insurance, all that stuff still applies, you know, and the reverse or not the reverse, but the corollary for the bank, which is, you know, their capitalization requirements around all of this, right? Absolutely. That still remains the same. So it's really not talking about, you know, creating something outside of the existing, it's within and working in the same way, just in a different means of transmission.
Right. And I know we're about at time, Adrian, but the reason I was bringing up all these types of altcoins and stable coins is when you start looking at the deposits, the big debate is how do you have, especially for international commerce, things other than just the US dollar. What we're talking about now with these digitized deposits. Yes, the banks are creating a controlled environment, adhering to current financial regulation, and they are having those reserves. It's just an extension of their current business model. What's coming in the near future are new exchanges, and some will go infused into these banks and they'll be recognized to collateralize digital deposits into these systems. That regulation is being discussed in Germany and Switzerland and Singapore. So we're on the doorway of that transition. But you're right.
Absolutely.
The current conversation of digitalized deposits today is in a controlled environment, reflecting fiat currencies, recognized by regulators as the reserves are held by the banks to carry out these operations with their internal processes.
Beautiful, beautiful. Hey, well, so we're out of time. Gentlemen, thank Eric, my co-host. Thank you very much for these weekly episodes and being on here. Wonderful comments. And Adrian, true honor and a pleasure having you on today to discuss this. And folks, this is episode 2. It'll be available on our website and on LinkedIn here in due course. And thank you very much and have a great day.
Thank you. Thanks,
You
guys.
all. Cheers.